When gas prices started to surge, government started to blame everything but not them. The blame was related to everything but not something that is in their area of influence. There was Putin, there was pandemic, but when the price of the gas, due to turn of circumstances, started to lower, they were definitely turning to their success. So that's the one of the thing that why you have to be skeptical of what really is going on in a policy. So right now the politicians are trying to admit that they have nothing in common with that what is going on in the US economy. It's not a recession, it's not a inflation, there is everything transitory, and should you really trust the economists who had previously told us that the inflation was transitory and right now is going off the chart? This is Blockrevision. This is another episode of our series when before the market open we're trying to go through the most important topics of what's going on in the stock market, commodities, cryptocurrencies, indexes, and so on and so forth. So let's get into next episode. So I will jump to another scene that is a Mrs. Yellens' speech. Yellen says that US economy is not seeing recession conditions now, and she believes there is a path to bring down inflation while maintaining a strong labor market. Especially that she really emphasized that there is no certainty that it can be done. So really she cannot even ensure us that their actions are the proper related to the scale of difficulties we are just going through. So she really believes that that's a path to accomplish the problems and to tackle every single hardness. But may it happen? Can we really rely on what she says? So yeah, the labor market is extremely tight. We can find there are some indicators that are improving. For instance, non-farm payrolls is not as bad as as many economists predicted. It may turn in this summer. Right now we are going through the north direction. However, many of the indicators starting to turn, and that's something that need to be pondered over by the government. So definitely labor market may be the source of some inflationary pressure. Also, many industries continue to see robust sales, but I do find there are many of divergences between, as yesterday been told, home prices and home sales. So that's why every single divergence may project a possible change in a direction for the future. So whether it's recession, there are some of the views that we are still not right over there. But it's funny because many voices I've been listening to, even assuring and admitting that the the definitions of what is recession has recently changed. As you can find on even Wikipedia, recently some of the users got to the information that the definition of the GDP that previously been stands at the point where two consecutive quarters of decline in the countries get us to a recession zone right now has been turned to there is no global consensus on the definition of recession. So whether we are in a recession or not stems to the decision of eight economists that are probably the most knowledgeable people in the world. But why they won't just put on the table the criteria of what they may find as the possible frames of a recession? That's exactly one of the enigmatic issue. So it's kind of a Rorschach test used by, I would say, the economy, and that will impact or will reflect of what this unit's type of really is. If they will find that we are right now in a recession, if everything gets us to that point, regardless of what's going on with labor market and personal spending, but nearly every other indicator is just pointing over there, it would mean that we are sticking with our direction of the past, where recession was the period of a slowdown. But would it be right now? Maybe the definition will change fundamentally. That's very, very interesting. So as we found, despite this very bad data, we got to the absurd of a situation where biggest fear these days in the market is strong economic data. So for the market, the weaker data is right now, that will mean loosening Fed's policy and probable make a pivotal change in interest rate hike policy. So right after yesterday's report, we have found that this exactly scenario putting us in a place where we are favoring more growth on major indexes. But that's not the case of just these days. Back in the past, historical data shows that markets usually tend to move higher in the weeks immediately following a second consecutive reading of negative GDP growth. That's because most investors believe the worst is over for stocks before it's over for the rest of the economy. So the markets are hitting anxiety, uncertainty. So this uncertainty we've been recently put into right now is getting over. We are I would say putting in favor maybe difficulties rather than uncertainties. So the market really is expecting the bad times to come, but they right now, after this GDP release, may prepare for it, and the enemy we may prepare for is better than the something that we cannot be prepared, as we don't know what we fighting with. So there's a stance where after those bad data releases, stocks rose on average of 0.8% 2 weeks out, while rising 60% of the time during that time period, as well as over the next month, CFI data shows. Recently, we have gained very well in terms of percentage points on S&P 500. That means that the market is pricing in that uncertainty is over, and we are heading into a easier path in terms of fiscal policy. So households are the one that recently is also been performed in a quite good manner. People still has excess savings that helps them to fight with this inflationary pressure. So they trying to so it's good after this pandemic time where excess savings been I would say gathered, and we can find that that's the money that need to and that may be used in a right direction right here for the most necessary goods. So right now we can find that this is something that may put us into a direction of that there might not be 100% recession as of now, because everything stems from the consumer. That is the this final element of the economy that decides when to speed up or slow down their purchases. So if the consumer still may have that money to spend on necessary goods, we still may have this maybe a little slowdown, but not a so of recession. So we'll wait for more data regarding this consumer spending. Total non-farm payrolls after few months of officially registered time of recession back in 70s shown us that jobs growth might happen even during the first phase of a recession time. So even with this initial jobless claims maybe rising, but not to that extent that may bother the government, it doesn't mean we are not in a recession. It's just a one factor that adds up to the whole spectrum of an issue of where we are right now. So right now I wouldn't expect the Fed to make a pivotal change. There can't be any realistic and sustainable pivot unless actual and convincing progress on inflation will be achieved. So as for now, there is no progress in that issue, and there is more likely that the Fed will remain its path. The private US real consumption, that's the recap of what I've been told just a while ago. So we are right now in a still in this very strong trajectory that put us in favor to avoid a very strong recession. Right now, real consumption is good in the US. That's regarding US, not the EU or Asia. But right now, the market is assuming that the Fed will change its direction due to FOMC median, and that's the market's path and they are assuming that Fed hikes won't be as high as right now, and after this 75 points hike rates, we'll find to maybe even revert from that brave trajectory. So the market is very brave in, or rather tired with this this pessimistic direction, but let's be realistic. That's very optimistic one, and I wouldn't really submit the same view as right there, especially with PMIs getting lower and just crossing through 50 basis points. We are right now going to the conclusion that there are around up to 11 factors, bad factors, that are right now going through the markets as supply chain disruptions, Chinese problems, such as with mortgage rates, and also COVID policy, war, inflation, and receding growth as well, and demand disruption. So I don't find this environment to be just a environment that resembles to high extent the normal correction, where we have of 3 to a maximum of 5 bad factors. So there is too many bad things that may lead even to some bankruptcies, to some defaults, and I do expect that even after market I would say calming a little bit with this rebound, this relief rally to happen maybe in August, I still do find it's rather more like that could bounce than a natural correction and on the way to move to the north. And that's the one chart that also showing us that demand measure turns south, and right now it's heading into a negative direction. First downturn since start of pandemic, real final, says to domestic purchasers. So there is more and more bad data. US growth is eroding from the bottom up. That's the Reuters conviction, and we can find that companies' stockpiles of unsold goods and materials shrank year on year. Also, the Walmart that recently been told about warned customers that customers are spending less on more discretionary non-food items. So that's something that also gives us in a position where we can find that these problems are starting to arise. Also, AT&T, those suppliers, is claiming that consumers are paying bills later, so it means that there are some troubles with that part of as well. So we just been going through this and expecting inflation. Yeah, so that's why I showing you the chart, because I want to point that consumers 5-year inflation expectations recently been at around 2 to 4%. So what I would like to just establish is that officials will say this isn't a real recession. Intensifying, it's only going to be a matter of time, but they not have a clue and didn't have a clue what this inflation will get to. So why should we listen to this? Better protect ourselves, better to get an interest into a stock market, for instance, or other investments that will help you to maintain this purchase power of your wealth. So I would say that the government's aim is to spread the propaganda and indoctrination in many ways, and that's why they would try to repeat that everything is on its place and anything is out of control. So technically speaking, we are already in a territory of recession, and it's hard to say what will it be, especially when heading back to 2009. No one ever predicted that Lehman Brothers may collapse. Scenarios might be as unpredictable as this year's inflation right now. Now also 2008 followed because of the Ponzi being built from too low interest rates, and that's why many of frauds started to arise. And right now that also may happen back in 2020, 2021, when this low interest rates been maintained, prolonged, in order to not spoil the party. But as we already shown and what been shown in crypto industry, there were some problems regarding the how the different tools, algorithmic tools, working, and also over leveraging of the space was one of the problem and one of the consequence of too low rates for a too long period of time. So the government won't admit that they made a mistake. Recession by many means was just hanging around there, and that's the chart that's showing that recession used to be in the past much more frequent than in the US. Than it's right now. So it means that the systems are getting maybe more resilient, or rather maybe we are trying to print over every single crisis that is on the horizon, and that may lead to a really serious problems of maybe even collapsing full nations and monetary systems. As every single time in the past, countries decided to turn their fiscal policy into a printing money out of thin air that haven't ended up really well. So they are trying to avoid any single bubble burst, but if they will finally happen, there will be a very strong consequences. So many millennials are believing that as it was in 2020, when the problems may raise up, Fed will turn up and claim that they will bail out everything. But what about 2008? That happened that fast and that easy. Right now we are in a area where we cannot really make quantitative easing in that environment we are right now, because it may lead even to hyperinflation. So when the more strict economic measure will turn up, we are in a kind of a pitfall from where there will be no very easy path to get out. So that's really something that doesn't bode well. On the better side, we may find that Elon Musk expects inflation to peak already, and inflation might be trending down as the commodity prices trend down for Tesla. That's the observation of Yellens. On the other hand, we have Chinese government as TikTok's effort, and that claims that this application stealth propaganda account, and that's not the first time we can find that right now TikTok is strenuously has denied that it would cooperate with any demands from China's regime, but as we know, this type of social media platforms becoming even more powerful recently, because there is a very easy tool that might be used to indoctrinate and also make a surveillance on citizens by giving their just an entertainment. And that's even more powerful tool than TV, because via influencers, via personalization of content, it's becoming more persuasive type of data, and gives you an even stronger message than TV. So why those authoritarian governments won't use it for their aims? That's, I would find, that would be outstanding by them. So I do find this social media platforms as a kind of a problem in some cases, but I hope this will be handled by regulators, and that won't happen in the future. In terms of market outlook, I would like to at first make a insight of what's going on with US 100, and US 100 right now is getting to the heights of this beginning of January consolidation, and that means that after this consolidation will be surpassed, I do expect that another stop for indexes is 13.5 thousandths. That's US 100. Right now I have just set an alarm right around these levels of 12,700, and I do expect this one to hit, and afterwards I find they're supposed to be revert and continuation of a trend that recently has accelerated to the upside. So projections for major indexes are rather good. Germany 40 DAX is also finding and making kind of a couple handle formation with an extension even up to 14,300. So this is one from the indexes insights. We are again going forward. Right here we have corporate sentiment that is a leading indicator regarding the earnings per share, and it means that earnings per share may get worse on the way to come. So I do expect maybe this earnings per share projections to slow a bit in the coming months. That's very nice parallel to what happened back in 2000s crisis, this dot-com we have a dot-com eco, I guess, where PE dropped back there on the amount of around 45%. Right here we are right at the levels of 40s, so we are very close to the possible bottom. However, back in 2008 and 9, during global financial crisis, we have slumped even more because we have dropped from lower levels, and the extension of the move was similar, but the percentage is remarkably higher. So we still have a chance to drop, but that may not be in a one move. In terms of crypto outlook, that's a very interesting debate about Ponzinomics. Many of investors are, I would say, make an allegation towards many of tokens that which float, which free float is resembling kind of the Ponzi's, because whenever the token is debuting on the market, investors, early investors, the seed investors, and also governors of the project are dumping many of percentage, token percentage on the market already, and that's the behavior that may be by some of the market critics assumed as possible illegal, and reminding the Ponzi-nomics. But as we find when designing tokenomics for a project in this crypto sphere, we need to just remind it it's kind of the conduction of an experiment on people's behavior. That's kind of a very new sphere of market experimentations, and that's why I do find there is still a very loose measures in which investors or other governors or early investors may move around. So that is why I would rather treat this type of investments as one that we are really need to be beware and also be cautious about. Right now it looks like more like manipulation, where people joining these communities of crypto tokens on a voluntary basis, very often they can choose to opt in or out, but if they not have an experience, they may be dragged into a kind of a also harmful actions, and may also lose money. On the better side of the coin, Ethereum dev confirms early merge date, the final update before the merge. So we are expecting Ethereum to switch to a proof of stake mechanism by September 19th, and that's very good news for Ethereum's holders. So the testnet's merge will be the final rehearsal before the Ethereum mainnet officially merges with the Beacon chain back in the second half of September. That's even better news that I have expected. I did find that that may happen somewhere on the edge of third and fourth quarter. But this exactly news is showing that the optimism is around even higher. That's why crypto is going through the new renaissance in terms of open interest. Right now, CME crypto futures see record activity during bear market, and that is been seen right here with this open interest and this volume just heading into the levels been seen on this peak of a mania back in February and March of 2021. That's why I do think there might be a stronger rebound from the levels of 20,000 in terms of Ethereum as well. That is right now getting slowly to the next resistance at 1100s, and there is still a possibility by September, by this March, to effectively been set off that by September we'll find still some growths ahead. In terms of market movers, we have recently found that unemployment rate in Japan was at the unchanged level. A PPI from Australia also as forecasted, and today on Friday we had GDP from France that is showing a better result than expected. That's why France index is rising more than any others, more than UK's and Germany as well. Inflation rate, however, is also dropping, so that's stems to a fact that France is one of the countries that is going quite well through these troubles of euro area. Unemployment change, however, in Germany has dropped, so its unemployment change has a little bit normalized and heading back to a neutral territory. And in terms of GDP growth rate, Germany also is getting into better side. GDP growth rate for the euro area is also expecting a surprising to the upside, and that means that euro area is still trying to handle this difficult situation they have found in. However, GDP from Canada is a little bit above neutral level, and personal spending from US is still advancing by 1.1%, so it means there is still some chances to avoid a tough recession. In terms of earnings, we can find that recently we have gone through AbbVie's earnings, Procter & Gamble, and ArcBest, and ExxonMobil and Chevron as well, that are omitted, and many of them were better than forecasted. So that's also giving a boost for the US economy. Amazon shows it can generate sales while slowing spending, so that's also positive after conclusions after earnings of Amazon that also advanced, and Apple beats on revenue and profit that expects growth to accelerate despite pockets of softness. I will just for a second head back to 28th of July in terms of earnings, and right here we have the recap of what had happened back then. Apple surprised to the upside, whereas Amazon has surprised lower, but it was in some of the expectations that e-commerce was suffering throughout recent months due to this pandemic going away and the slowdowns as well. So Amazon reacted positively even on that bad data. That's why we may think that this market is strong. Trade idea for today. I would like to make a further discussion on US 100 that right now is dropping a bit, but still have a chance to rebound if this candle won't be I would say totally engulfed by this selling pressure. I do find that we may get even higher, but we need at first to consolidate maybe a little bit on these highs. This 2 power candles is showing that we may still find a rally to the upside, and I do expect this one to happen, but at first we need to defend this area. This power candle shouldn't be engulfed by this negativity that are right now seen on the chart. I would like to make a insight into what's the sentiment around Nasdaq, and this is a 50 to 50 nearly. Position value is 51 to 49, but number of clients are rather selling than buying. So it means that position value is to the upside, but more clients are negatively positioned. So it means the odds are to the upside because bigger money are on the minority. So in terms of US 100, yeah, as I just told, I do find this one to rebound, and in terms of area of entrance, I still expect will rebound from this area right here of somewhere around this zone, and will head north in the next week up to 13,500 points around. So in terms of trading both, there will be risk reward ratio at 7.5 this time, if they will succeed and come to fruition. So that's very, very, I would say, decent trade that may get been accomplished. So if we won't get back into this area of blue box we are right now hanging around, I won't find this proposition of a trade as valid. So remind about the alerts, and also putting a stop losses in order to defend your position if you decide to enter. So that's it in today's episode. Thank you very much for watching. As always, If you enjoyed, just click the thumbs up button and subscribe to be updated. Thank you and have a good time, have a good weekend. See you next week.